Hello, Maverick Traders. This is Rob Reinhold. I'm joined by Mr. Darren Fisher, and here we are. I cannot believe that 10 months of the year are gone. We are all the way through October. Only 2 more months left, and then we're going to wrap up 2022 in a bow and move on to 2023. So let's jump into this week, because this week was a pretty wild week, and it really was a week of two different markets. When we take a look at the Dow, now look, the Dow is such a small index. It's only 30 stocks, and it's a weighted index. I could write a paper on how terrible the Dow is. But when we take a look at Dow-like stocks, they soared. The Dow has been the biggest outperformer of everything. And the S&P also was very strong all week. The problem was tech was a wreck. Tech was terrible. And we had terrible earnings from Google, from Amazon, terrible earnings from Meta, and terrible earnings from Microsoft. And that kept pressure on the NASDAQ all week long. In my Thursday end of market video, I actually said one of two things have to happen. Either the S&P-like stocks are going to rescue tech because tech was weighing them down. Either they're going to pull tech up with them, or tech is going to pull everything down with them. And I said on Thursday, I didn't know which one. Well, guess what? We found out on Friday. Friday, the NASDAQ opened down. It opened weak. We had Amazon down 15%, and there was buying all day long. So the question was answered. The rest of the market is going to pull tech up. Now look, tech is going to stay weak. There's no question about it. But right now, there's a lot of money going into stocks. We also had a couple other positive things. We had the dollar back off its high. We had the 10-year bonds trade off its high. So overall, this was a market situation where the people felt, okay, that was a bottom we put in October 15th. And now we're having a nice little bear market rally. Darren, what are your thoughts about this week's rally?
It really surprised me, especially Friday's action. I was generally caught off guard by it. And we had that nice, a nice gap up and a fall for about 3 days of the week. And I was expecting Friday to do something similar. And, been doing this for 20 years, and I still get, sideswiped on occasion.
Yeah, it definitely was. Like I said, it was, if you were looking at tech, you were super, super bearish. If you were looking at something like the Dow outperformed. So it really just mattered of where your eyes were. And if we take a look at the news events we got last week in the economic reports, I want to kind of break it down because we got lots of weakness. So take a look at Monday. We had flash services PMI. That was a bad number. 46.6 and 49.9. That's a bad number. We got the Richmond Manufacturing Index. Another terrible, terrible number. Consumer confidence misses expectations. Then we get Thursday, we get a better than expected GDP report. All right, now let's talk about these numbers because there are leading indicators and there are lagging indicators. Lagging indicators are things like GDP, what happened last quarter. There are also things like prices. Inflation is actually a lagging indicator. And so when you take a look at the numbers we got last week, better than expected GDP, a PCE at plus 0.5, unemployment claims very low. These are lagging indicators. When you take a look at the leading indicators, things like manufacturing, they were weak. And so the market really liked that. Remember, we've been talking about this for the last month. Good news is bad news, and bad news is good news. The market wants to see weakness, and they're seeing it in the right places. I'm not going to jump to the premise that the Fed is going to see that and say inflation's done. But when you take a look at the economic numbers, all the leading indicators are really, really bad. And that's actually good for the market because the market wants to see the Fed back off. So if we take a look at the numbers, Dow Jones almost up 6%. That is just such a monster rally. And the Dow is up 15% for the month of October. Amazing. Outperformed everything. S&P up 4%, and the Qs, they were able to come back and put in a positive gain. After the bell on Thursday, the Qs were actually down 2.5% for the week. So we had almost a 5% reversal on Friday from the low to the high. So everything just got a really nice bounce. So let's take a look at where we are on the charts. Now, this is where I love charts because we always try to figure out, okay, where are things going? Where are things right now? And if we use our brains, what's going to happen is we're going to use our biases. We're going to use what we think is likely going to happen, and we're going to have a interest in seeing one over the other. So if I have a bunch of bearish positions, I'm going to look at charts with a negative viewpoint, and everything I'm going to see in them is negative, and I'm going to ignore the positive. Vice versa. If you're super bullish, you're going to ignore bearish things. So what we want to do is just take a look at the reality. Now, one of the lines we draw in the sand at Maverick is the 50-day moving average. The 50-day moving average is the line in the sand. Above it, we're net bullish. Below it, we're net bearish. Now, this is just a very simple way to just orient where you are on trend. There is no doubt here that we have closed significantly above the 50-period moving average. We also have the 20-period moving average starting to cross higher. And so what it's telling us that prices over the last 20 days have been going higher. We don't have the 50 going up yet. That's a lagging indicator. We'll start to see that. When we take a look at what are the key areas here, we are at a pretty key area here at 390 on the SPY or 3,900. This is going to be a little bit of resistance. We spent a lot of energy on Friday. I wouldn't be surprised at all going into a Fed meeting if we get 2 or 3 days of sideways movement right around 3,900. And then we do have the Fed meeting on Wednesday. And I think Wednesday is the price action that's going to matter. If the market parks here at 390, and then on Wednesday, the Fed drops a bombshell, the market doesn't like it, okay, I will say that that was probably more of a bear rally and that might be done. If we break out above 390, I want you to look at this chart. Where is the next resistance level? I don't see any resistance level until 410. That's 5% away. So I'm looking at this chart thinking, okay, so maybe the market pulls back a little bit next week. Okay, maybe it's down 1, 2, 3%. The market breaks out next week, it could potentially be up 5%. Looking at that, I see asymmetric risk on one side and asymmetric gain on the other. I'm liking the long side better here. What do you think about that analysis, Darren?
Yeah, I mean, you can see it. You nailed it exactly. Looking at the spiders here between 390 and 410, there is absolutely no resistance there. And you could look at the gains we made. We could do that in 2 weeks. We do that in a week and a half if it is. I would like to see what happens after the Fed meeting. I think you're right. That's the key day, and I'm not going to be making any outsized bets until after that Fed meeting results come in. I can see which way the market's going to go.
And speaking of which way the market's going to go, we jump over here to the Qs, the NASDAQ. It's a different story. We are not trading above a 50-period moving average. Our 20 is basically just flattened out. So saying, hey, prices aren't going down anymore, they're just going flat. Look, this is overall bullish price action, higher highs, pull back, make a higher low, run higher. Okay. It's generally bullish price action, but it is not quite as bearish as the spiders and the Dow. And so if you're wanting to have a bearish outlook here, I think you've got to say this is where the bearishness is. I don't think it's all that bearish. I think we're still in a bullish pattern. But if you are going to be short or want to be short, then this is where you should be because it's clearly showing some underperformance in the markets. It's very clear here that the NASDAQ is likely to underperform. If we come over here to the VIX, look at the cratering of the VIX. Absolutely cratering. We talked about every time I got up to this 32 to 34 area was our high, and you can see that we have blundered all the way down to 26. That's right in the middle of the range. So the VIX is showing us that people really think this bounce has some legs to it. And not just this bullish, but I want to talk about how broad this market rally was. If you take a look across the board, everything but large cap tech participated in this rally. And we're going to go through the sectors here, and you're going to see that every sector had a really nice recovery and a bounce in this. And it's just showing you that money isn't just coming into a few places. It's a big wave of money going into all of the places. And so whenever you see a broad market rally, that tells you that it's got some staying power. So with the VIX coming down, the broad market looking good, I think the question is, what happens with the NASDAQ stocks? I think the rest of the market goes up, but can the NASDAQ basically be taking along with them? Let's talk about next week. So next week, we do have the Fed meeting on Wednesday. There's another 0.75% hike expected. That is almost a guarantee to happen. I don't even think the Fed funds are showing anything other than that. The big question is, what are they going to say after that? If they come out and they say, we are starting to see signs that our policy is working with slowing this, slowing that, the market is going to like that. They're going to like it because it's a sign that the Fed is saying we are at least considering pulling back based on the data. If they come out and say we still have a long way to go to fight inflation and we don't see any softening, yeah, the market is not going to like that at all. But I just don't see how they say that because there has been some clear softening. But I want to talk about one report coming out this week, and it comes out on Tuesday, and it's the JOLTS job openings. Now, the JOLTS, this is a number that no one has ever cared about. Now, look, I've heard about this JOLTS number for like a decade. No one's cared about it. It has been a completely meaningless one you could just forget. All of a sudden, it now matters because the Fed, in their last press conference, said they want to see things like the JOLTS numbers, job openings, come down. Now, I saw the forecast is for about 9.5 million, 9.5 million is what the forecast is going to be. If the number is below this, I think the market really rallies because this is what they want to see. The Fed said we want to see the job openings come down. If that happens, let's say this comes in at 9 million, below 9 million, this is going to say to the market, the Fed is in the ending of their cycle and the market is coming down. We're going to get a rally. Now, look, this economy is still in decline. We're definitely not out of the woods, but the stock market is going to be looking through these numbers and say, okay, this is what we want to see. I think this JOLTS numbers, for the first time since I can remember, is a very meaningful thing because it happens right before the FOMC statement. And then again, we get the press conference after. That's probably where we're going to get the most fireworks. Remember, you usually get 3 moves after a Fed meeting. So let's say that the move was up, you get the initial move, then you usually get the retracement, and then you actually usually get the move. So this is what we expect. We expect there to be a period of time that is chop. This right here is chop and garbage. And people that are trying to trade this, they take positions, they get stopped out, they go short, they get stopped out. We always like to tell our traders, just sit out for those 30 minutes. Let the true trend show what it's going to be, and that's what we're going to trade. So I'm with you, Darren. I'm not looking to stick my neck out at all, even though I am fairly bullish at this point. I am not looking to stick my head out in front of a Fed meeting and guess which way it's going. I'm just going to sit back and watch for it. Then on Friday, we've got employment report, as usual, first Friday of the month. And it's not going to be as big of a deal since we just heard from the Fed. So I think that this report can pretty much just go away. I don't think it's going to be a big mover as far as the market goes. So we do have to upgrade everything. I don't care how you feel about the current state of the economy, about the current state of whatever country you live in, about the current state of whatever political party you assign to. A chart's a chart. And when we do scoring on our charts, we throw away all that and say, okay, what is happening in front of us? We are above the 20 MA. We are at the 50 MA. Again, we're trading above it, but we want to see one more candle. And we have a 20-50 slope. One's going up, one's going down. We're at a +1. It's telling you to be mildly bullish the market, not wildly bullish. but mildly bullish the market. So we think we probably have a little bit of follow through this week after the Fed meeting. Darren, what's your call on the market this week?
I mean, yeah, technically you just have to be at that mildly bullish +1. I mean, no matter what I feel, I've got short positions on. Those are currently hurting. That's part of trading. You just have to reevaluate and look at the market in front of you. And, whether you like the market in front of you or not, that's the thing. That's what the market is saying. So let's take a look at some sectors here. So you can see on this histogram, industrials was probably the best performing sector out there, plus 6.7%. Real estate, kind of surprising, up over 6 as well. Utilities up over 6, and financial. So we had 4 sectors of 10 that were up over 6% in 1 week. I mean, that's just been the volatility of this entire market. Healthcare was up there too, coming in at a respectable 5, along there with tech broadly. What really didn't surprise me, because consumer's been weak. It was the least. It still had a positive gain, but when your big brother's making 6% and you're having trouble getting up to 2, there's some weakness right there. So if you're going to go bullish, I'd look at the stuff that's moved already, because I mean that's just where the money's flowing into. We're going to take a look at it. So let's take a look at the individuals. Definitely had some upgrades on all the sectors. So you can see here, we've managed to get above the 20, but we're still below the 50 in utilities right there. So I'm gonna zero on utilities for the coming week. I think we're going to be kind of range bound in there, between that 65 area and that 70 area. We'll see if it can't get the energy to move past that 50 period moving average. Then I'll be much more bullish on that. Communication services went at a -2 last week. We're at a -2 this week as well. It just couldn't do anything. I mean, it had a decent candle on Friday, but you can see Wednesday and Thursday, it was nothing but down, all the way down. I mean, that's for an index like for an exchange traded fund like this sector index, that's a heck of a move that we've seen. So I mean, this is more looking like a bear rally pattern. But we'll see if we haven't put in that bottom, and if we just base. But it still looks like communication services wants to go lower to me. Real estate, surprising. This was one of the redheaded stepchildren. It's been there for a while. Had 2 really good days this week on Tuesday and Friday. So it puts us above that 20, below the 50. For us, that's a 0 right now. So I think until it can get above that 50, it's just going to probably run around in that range between the 20 and 50 period moving average. Industrials, this looked really good. This was at a 0 last week, and it's at a +2 this week, firmly above the 50 period moving average right there. And the funny thing is, it's also right at the 200 period moving average. So that's the long-term trend. If we can get above that, industrials probably has some decent legs. I think once it gets above that, you could get up to 100 quite easily, because that's about the next, that previous high, I think, is where the next real resistance is right there. But we'll see which way it goes. This is one of the stronger looking sectors that we've had. Healthcare is another one that looks pretty good. +2 on healthcare. I mean, this is even more of a +2 than industrials is, because this is really, really close to the previous highs. It had a little gap, and it just kept going right there. Had 2 gaps in the past week, and that it didn't see any need to fill those. And you can see Monday, Tuesday, Wednesday, it was looking really good from a gap up, and then Friday had a great run as well. So healthcare, definitely a place to be looking for longs. Financials, another one that did the same thing. I mean, when you get something that goes up 6%, it's definitely going to move you. We were at 0 last week. We're at a +2 this week. This is probably a little weaker +2 than healthcare is, but still, you've got a lot of room to run right there. I think that 200 period moving average 35 is probably your next target if you want to get up to there. But then up to 36 is where you could presumably see after that. And consumer, no, they were at a -2 in consumer last week, and we're at a 0 right now. You can see we just we closed up 0.1%. So not a stellar day for consumer. And you can see, consumer's been weak for a while, and people are expecting it to continue to be weak. So we'll take this as a gift. I'm going to, be playing this sideways, until, if it drops back down below that 20-period moving average. I think we go down and retest the lows quite easily. But until it does, I'm happy to just play this sideways. Tech was in a -2 last week. We're at a +1 this week. I'd definitely like to see one more candle before we commit to it. But just from the action we had this last 2 weeks, I think you'd be mildly bullish broad tech, not necessarily big cap tech, but just tech broadly. I think you'd be mildly bullish on. And we see materials here. This is another one that's kind of in the same situation. We were to 0 last week on materials. We're at a +1 this week. So retook that 50, starting, looking a little better. You can see there's been a lot of technical damage done here, but it's been clawing its way back the past 3 weeks. Held above that 50-period moving average for the last 3 days. I think you mildly bullish on a lot of these base materials companies. And finally, our good friend energy. Now, although it didn't have very good days, Thursday and Friday, you can see some red candles, but take a look at that long lower shadow on Friday. Even though it didn't close with a green candle, it still closed up, and this is looking pretty good. So technically, you just have to be +3 on energy right here. It's looking very good. So to put everything in perspective here, worst performing communication services at a -2, right at 0, consumer, real estate, utilities, mildly bullish materials and tech, more bullish financials, healthcare, and industrials at a +2, and energy just seems to be bulletproof for most of this year at a +3.
Hey, Darren, I wanted to point out just 2 weeks ago, everything was below 0 except for energy. And over the last 2 weeks, everything's just been creeping up higher and higher. And now we're starting to see that now the bulk of the market is actually trading in the positive rankings, which again is another reason why we are overall saying, hey, that was probably the bottom, a tradable bottom. We're probably going higher from here. Because again, you should see everything in the sectors come along with it to really validate the move you're seeing in the overall markets. It's just very interesting how quickly these things have all moved over to the right.
Yeah, you're right. I mean, the past 2 weeks is really when we've seen that move. It's just been, first you're looking at it and going, okay, is this just bounce? Well, this thing's got some legs to it, it looks like. So let's take a look at some potential trades here. So last week, we had a short trade in real estate in BXMT. But, as with, anything that came up, you can see it was up 11.87% right there. I mean, you can't argue with the chart. If we would have been looking at this on Tuesday, it would have been looking pretty good. This is probably just a blown trade. That's what happens. Book the loss and move on. Don't agonize over it, because you're going to have this stuff happen several times a year. Just let it go. So what we're looking at here is Host Hotels, and we're going to play this one sideways. So it's probably going to be range bound. You've got some. Take a closer look at the chart here. You got some good support at 16, and then some good resistance about that 1950 area, and we're just a little bit above the midpoint on those. So this is going to be a decent one to play sideways. I'm going to be looking at this with the 17-19-21 call butterfly. So I think we're bound up there pretty well. I mean, you could even decrease that a little bit and go down to the 20 if you wanted to. It'd be an off-centered butterfly, but you probably get a little bit better return on that one. If you want to play this a little bit longer, go long the December 16 calls and then short the November 19s against it. In communication services, last week we were short Baidu. That's what paid out for us really good. Despite the fact the market just rocketed up, Baidu was down 13.9% for the week last week. And you could see even with the good week that people had, you get that little mini bear rally that we had right there. And it looks like it's going to have continued weakness on there. So if you're still in this trade, this one's probably got a few more legs to run. This week, we're looking at Zillow. And communication services has just been, it's been weak for so long. It's almost a recurring joke here at the firm. This had a very nice bear rally. Just came up there, touched that 50-period moving average, couldn't hold the gains. Long upper shadow on Wednesday, red candle on Thursday, and you'd see the green candle, lower low, lower high. This is confirmed. How do you want to play it? I'm going to go out to November 11th, second weekend in November. I'm going to play that 29.31 bear call spread right there. I think that's going to give me a little bit better return right there. If you want to just go out and play the 30.31 for 1 week, that's a way you could do it too. In healthcare, last week we were long AKRO, that's Caro Therapeutics. And this one just kind of held out there. It was down about 3.9% for the week. Still a bullish chart pattern right there. It's just stayed above that 20-period moving average, touched it. We got what looks like a doji on Friday. So there's some more time in this trade, and I'm comfortable holding on to this one and seeing where it goes. What we're looking at right now is United Healthcare, UNH. This is just bullish action. You can see we poked above on Friday. We poked above some long-term resistance that we had from several months. And so if we can get if you want to call this confirmed, that's fine. If you want one more candle above this period, that's fine too. However you want to play that one. And what I'm going to go and do kind of a mini diagonal right here. So go long November monthly 540s, and then short this next Friday's 550s against it. Make it into a diagonal call spread, and then I can reevaluate, next Friday and see if I want to hold it out to the to the third week. If you want to be a little bit more aggressive, if you think this bullish action is going to continue for a while, you go out and go long those December 540 calls. Now check your account size on there, because those are going to be fairly expensive, and I would put probably a 30% stop loss on those.
And Darren, this one, I love that you broke it down with the diagonal, which is the wimpy play. Hey, if you just want to do a wimpy play, the 540, 550, I think looks great. Or you could say, hey, I think this one's really going to break out and run, because it is setting up for a nice breakout. I really like it here. But that's a great thing about trading. You get to decide how much risk you take on every single trade and decide what you're actually looking to grab on each trade. Let's shift on to industrials. This is a fantastic sector. As Darren said, going through sectors, this one really popped up, +2. Last week, we actually had a sideways trade on CAR, Avis, and you can see that it did not want to stay. Remember, sideways stuff, you say, hey, I think it's going to stay in this range that it's been in. And it said, hold my beer. I'm out of here. Rocketed 28%. So this is why with butterflies, we've got a limited risk trade on, so it blew well out of this, and rarely do these ever come back down. So this is going to be a max loss on CAR. This week, we're going to take a look at Caterpillar. Now, Caterpillar had earnings, and take a look at this run in Caterpillar. This is just a monster run. And Caterpillar was already looking really good. Remember, the market bottomed out October 15th. Caterpillar bottomed out September. So this has shown you, hey, this one bottomed out well before, and we took out these resistance at 200. Pretty serious resistance was taken out. So here we are, we've got this stock that is just on fire, but it's also spent a lot of energy over the last week or two. So this is where I'd love to take a look at these and say, you know what, I like the stock, I think it's going to hold its gains, but it's probably going to have to take a break just for a little bit. So this is where a sideways trade can easily come into play here. The stock's right at 220. So the big question is on any sideways play is, where is your target? Where's your target? I'm looking at 2 weeks. So I'm asking, okay, in 2 weeks, where do I think this is? Now, I do think the market is higher in 2 weeks than lower, but I'm thinking that this one is already played out. This one is already gone from 180 up to 220. I think this one's going to hang out in this area. So I just want to put in a butterfly right in this area, be patient on it, and let that theta decay on it. Moving on to financials. Last week, we had Travelers Group on the long side and just a beautiful, beautiful chart here. As you can see, short little pullback, got a nice hammer candle here, We rocketed up, closed at our highs, and we closed out of this resistance that's been there at 180. So next target on this one, 185. I think this is going to be a really nice trade based on how you structured it. This week, we're sticking with sideways. Now look, hopefully you're seeing that everything is like we talked about being at a +1. Now a +1 means you're sort of bullish, but you're not really bullish. But you need to be leaning for positive delta. So all of our trades this week are really looking at ways to get some delta exposure, but not sticking our neck out too far. And that's what really where you are on +1. That's what +1 is telling you to do is be bullish, but don't stick your neck out. +2, +3, hey, that's when we stick our neck out. But right now it's saying, no. Here's Wells Fargo. We are right up to this major resistance point, right around this 46 area. We bottomed out well higher than the June bottom. So this is a sign that this stock outperformed the average stock because the average stock bottomed out on October 15th. This thing did not. Here we are right up to this resistance level. Just like in Darren's United Health trade, you get to decide, how do I want to play it? Now you could play the chicken way, and that's the way I'm going to play it because this is a +1 market. Go out, go long the 44 call, November 18th, and then short this Friday's 47 call. Basically, what you're doing here is you're saying, okay, I think by next Friday, it's going to be somewhere around 47. And you're opening up a trade. Diagonal call spread is going to look like this on your risk graph. As you can see, if this thing blows out, let's say the market gets really strong next week and blows out all the way up to 50. Okay, you're going to make money still, but you're not going to make as much money as it stayed at 47. The great thing about these is all of a sudden now you're down here at 44, let's call it 44 and a half. That's your break-even point. So this thing could hit this resistance and come down, and it's a very comfortable trade. It's very comfortable, and it's only lasting a week. Remember, we're selling this Friday's call, and then we get to reevaluate the trade on Friday and say, hey, do we want to hold it? What do we want to do with it? So these little mini diagonals, as Darren called them, are just really great. If you want it to be more aggressive and you think it's going to break out and run higher, because if it does break out and run higher, 50 is the next target on this, then you could take a look at doing, something a little bit more aggressive. Here's a target of butterfly as well that you could look at do in this area. So again, there are lots of choices with options.
Yeah, so last week in consumer, we had CarMax short, and this is another one. And Rob, you and I were talking about this before, and we've got to trade the market in front of us, but a lot of stuff that we had been short was just, the chart looked absolutely beautiful from a short side, but these things just rebounded so much. CarMax was up 14% for the week, and what was just an ugly chart from if you were long the stock. So that's one thing that gives me a little bit of pause as to whether or not this is a true tradable bottom rally, or if is the move done. Just food for thought there. So this week we're looking at Ross Stores, ROST. This one we're going to play sideways to bullish. You can see we're at resistance right now, right about that 95 area at previous resistance. So this is another good one to be. I'm going to play it with a diagonal right here. Go long the monthly November 90s and short this next Friday's 96 and turn that into a diagonal call spread. We're going to have about a 3-week trade on this if I want to do something like that. Now, if you think consumer is going to turn around, because it's been looking pretty weak, but if you think the whole consumer sector is going to turn around, this is looking better than a lot of other stuff. You could go long those December 90 calls. That is another option for you, but that's a little more aggressive than the diagonal call spread. In technology, last week we were sideways on Solar Edge, and this is another one that it looked like a sideways chart for a good amount of time, but the market just pulled it back up. This was up 14% for the week. Probably again not gonna come back into our profit area. Just write it off. This week we're looking at APP, which is Digital Turbine. Despite the fact technology was up considerably, this just stood there in a low base and watched everyone else go play. So this one's looking pretty good. This is a nice low base right there. Now, but if we think the market's going to go up, we can't expect too much out of our bearish trade. So going out 2 weeks to November 11th, do that 16-18 bear call spread. Right in the middle right now, you're probably going to pull about $1.10 out of this. How about 90 cents in risk? And just let the theta decay and see where you are in 2 weeks.
Moving next to materials. Last week we were short AVTR. It actually dropped nicely. You can see big move down on Friday, 6%. So nice trade on this one. Moving on, we have Axta, and we're looking at this one sideways. As you can see, this is the way we're going here. We're not sticking our neck out too far. We're looking to be slightly bullish to sideways. We've got a stock here that's just trading here between this range. 21 on the downside, 26, 27 on the upside, somewhere around there. Moving averages are just flip-flopping back and forth, crisscrossing. This is the anatomy of a sideways stock. The big question is, okay, where do you think it's going to be on your target date? I'm looking at the November 18th. Now, again, we can do a targeted butterfly, which means we think it's going to be up a little bit more. If we think it's going to be up closer to 25, then we want to make a butterfly with 25 as the midpoint. If we think it's actually going to move down a little bit, closer to 22, we do that. I'm looking at this, and I really like this range. I'm looking to just do like a 21, 24, 27. What that's going to do, that's going to give us a risk graph. Just really nice controlled trade where it just has to close between the two break-even points. So looking to just be, again, perfectly sideways, a touch bullish on this one in basic materials. Energy has been a very strong sector. Last week, we were long Matador. It actually was down a tiny bit, but, still a nice week. Nice week, had a nice long lower shadow here on Friday. I don't see any reason why this doesn't continue to climb into next week. This week, Occidental Petroleum, we're looking for, again, sideways to, slightly higher. Let's take a look at where this is. Now, I am looking at energy. Energy has been the clear outperformer. And everything else has been an underperformer. So what that means is that the money's been going into energy. Anyone who's wanted to be long, they've looked at everything else as it's all trash. I'm going to energy. Here's a question. Will that hurt energy if all of a sudden everything else looks much better? And I think you can see the answer to that. On Friday, the answer was yes. Energy didn't do great on Friday. So the better the market does around energy, I think it actually hurts energy. So I'm looking to do this sideways trade slightly bearish here. So I'm looking at 70 as that midpoint. So what I want to do is say, let's go with 65 on the downside, 75 on the upside. I'm looking for this to basically be within this window. Looking for it to be within this window here with a slightly downward bias to where it is right now at 72. That wraps up our trades. If you want to talk with other traders, jump onto the Maverick Trading forum, and let's all share some ideas. We always love when our traders work together to help make the whole group more money. To wrap this up, markets are looking much healthier. I mentioned the breadth. This has been a very, very broad rally. Lots of stuff has gone up. And look, Darren, you pointed out, the worst stuff has had the biggest bounces. It's true. But the regular stock has also had a nice bounce. So it's looking much healthier. Now, it doesn't mean it's out of the ER. I'm not saying that was the bottom of the bear market. But just right here, right now, where you go in cycles and waves, we just had a big down wave that lasted for 3 months. Now we're starting to have this beginning of an up wave. No one knows how long it's going to last, but we have to ride that wave until it's over. We do think that the big cap tech is likely to underperform. So other technology, fine. I think you want to avoid the chip stocks, the big cap, internet stocks, stuff like that is going to underperform. If you want to be in tech, look at some other things. But look, there's so many better things than tech out there. Industrials, financials, real estate is even looking better. So I think you just want to be focused on where the money's going. And as always, properly position size everything. Risk management is the name of the game. No matter how good your analysis is, you're going to be wrong on some. That's just a given. Are you going to let those break you, or are they just going to be one of the ones in the loss column? If you position size correctly, there's no way it can cause you a lot of pain. It's just one of the ones that goes in the loss column. So as always, risk management is key. Thanks for joining us. Everyone have a great weekend, and we'll see you next week. Goodbye.
Good trading, everyone.